for a long time now, for the last couple of months, I've really been trying to think about the upside tail that we could see in our markets. Markets are driven by tail events. Basically, what that means, if you don't know what a tail event is, it's like COVID that kind of comes out of nowhere, and the boom to the consumer and that we seen during that time. That was a tail that nobody could forecast. So what really drives markets more than anything else is unforeseen events. Okay, this is like World War II that obviously nobody was expecting at that time, that really boosted the American consumer after the war, that boosted manufacturing, that caused a boom for the U.S. economy. Since then, really, it hasn't stopped, okay? The markets are driven by tail events, unforeseen things that happen, good and bad. Now, I've been trying to figure out what the tail event could be in 2025 that markets are not expecting that could push markets higher. Trying to kind of formulate this risk to reward profile of, hey, should we be investing here? Is it time to pull back? Are we in for downside surprises? And I came across this video that kind of perfectly sums it up from CNBC. It says, former NEC chief economist says tariff worries are overblown and inflation will drop under Trump. Now, I don't give a rat's ass what political spectrum you put yourself under. Okay, doesn't matter. This is what I've been saying now for really since the election, that I don't think inflation will be as high as the markets think. And I don't think tariffs are going to be as extreme as they were promised under the campaign trail. One, because the markets are going to dictate what Trump can do as far as tariffs. If Trump announces a tariff and the markets crash on that, like, it's not going to be implemented, right? Anything that really threatens financial stability, that does not progress the U.S., ahead, is not going to be enacted. And these are two tail events that could drive exceptional returns next year if inflation falls more than expected, allowing the Fed to cut rates more than expected, and if Wall Street is wrong on tariffs. These are two big upside positive surprises that we could have next year. Now, I think if these two tail events did happen, lower inflation, more cuts from the Fed, and less tariff worries, or the actual tariffs that we see are not as bad as we think, I think this would really drive the small caps, the cyclicals, the mid caps, obviously more than big tech. So we'll talk about that in just a moment. But first, I want to play you this clip. It's 3 minutes, 54 seconds long, and I highly recommend that you watch the whole thing.
The Fed's preferred inflation gauge, the Personal Consumption Expenditures, PCE index, was in line with estimates for October, according to this morning's data. This latest reading comes as some on Wall Street worry President-elect Trump's proposed tariffs will have an inflationary impact on the economy. But our next guest says that won't be the case. Joining us now is Joe Lavonia. Joe is chief economist at SMBC Nikko Securities America and a former chief economist at the National Economic Council under the first Trump administration. Joe, good to see you. So
Thanks, John. Good to see you.
You say these inflation numbers today are fine, but not great, but that President-elect Trump is going to get it down to 1% next year while moving ahead on tariffs and immigration policy. How does he get 1%?
I'm not sure. It's going to fall about 1%. It's around 3%, give or take a little. So it'll go from 3 down to 2%, which is price stability. And that'll happen, John, namely through a couple of things. Number one, certainly lower energy costs, which filters throughout the economy in so many ways. Energy is such an important input into the production of so many items. And of course, anything that needs to be transported obviously is dependent upon combustible engines and energy. So certainly lower energy costs combined with what I think, John, will be a very supply side-led animal spirits increase in capital spending. Capital spending inflation tends to be quite low. And when you have capital investment, it adds to the capital stock or the economy's productive output. And that should also keep inflation down.
Thanks for clarifying that. There's a big difference between down
big difference,
one point and getting
I mean, it
down
could be. Look, under Trump 1.0, inflation was, by the Fed's metric, was actually under 2%. It had a one handle on it.
Right.
So we could get back there at some point. So I'm pretty optimistic inflation is going to come down and that it's not going to be the problem that we've had the last 4 years.
Now, why won't immigration action and mass deportations shrink the labor supply such that the cost of labor goes up and actually fuels inflation?
Well, part of the problem, John, is that we're looking at if these are illegal workers coming in many cases, they're not even part of the official wage data. They're not part of the household survey that measures unemployment. And in some cases, they're probably not even part of the establishment survey, which, by the way, shows that we actually have fewer jobs than what the government was reported. We had data last week from the BLS that showed that in addition to the roughly 800,000 in downward revisions we're likely to see as of March of 24, we lost an extra 400,000 jobs by June. So we're talking over 1.2 million fewer jobs. So there is tremendous unused labor, you could argue, in the United States economy. And therefore, this notion of deportation somehow leading to what economists would call is a leftward shift in the labor supply curve, I just think is completely inaccurate.
So you don't buy the argument that the jobs that these immigrants are doing are jobs that the people on the books don't want to do?
No, what I'm saying is I don't think in many cases the people that would be deported are functionally a real integral part of the market. In fact, if we look at deportations under President Obama, we had about 3 million deportations over his 8 years. And under Trump's first term, there was less than 1 million, according to the ICE data, ICE, which is part of DHS. So, no, I don't think that we're going to somehow have this shortage of labor supply. By the way, if we look at the labor market, what we're seeing is job growth slow, labor supply, labor force participation still below its pre-pandemic peak, and we're seeing wage pressures moderate. So we're not going to get inflation from less labor. And by the way, inflation is not a labor phenomenon anyway. It's a money and credit phenomenon.
Let me get
too much money chasing too few goods.
Just tell you right now, if that guy is correct on what he just said, markets could hit 7,000 next year. Now, I think the composition of market leadership is not going to allow that. In other words, I think big tech would not really benefit during that scenario with lower inflation, more rate cuts, less aggressive tariffs as the markets are currently expecting. It would really be small, mid-cap, cyclicals, high growth names. All of your big tech stocks, they're not really big growers. They're seen as this defensive trade. And considering they're 35, almost 40% of the S&P, if you don't have as much participation from the Mag 7, you would need markets internally to go through some kind of parabolic rally to get a big move higher next year with some price targets from like Ed Yardeni at 7,000 for the SPY. I just don't think that happens without big tech really taking some leadership stance next year. And I don't see that happening. Obviously, I could be wrong. So as I've said before, bullish on mid cap, bullish on small cap, bullish on cyclicals. If we do see real growth in the economy, not just government spending growth, but real growth in the economy, those areas are going to benefit alongside a positive surprise from less aggressive tariffs than what was promised and more cuts from the Fed. Now, I'll tell you right now, regardless of what the inflation scenario looks like next year, we're going to have less aggressive tariffs that actually are implemented than the campaign trail. A lot of Wall Street is still talking about 60% blanket tariffs on China and nonsense. That's not going to happen. That is indeed going to be a positive surprise because the U.S. economy really just couldn't handle 60% blanket tariffs. And Trump's not taking over the job with markets at all-time highs to crash them for many years. That's just not the playbook that Trump has for his term. Now, I think the one big risk that we have is there too much damage done in the labor market where we were destined to go into a recession anyways? That is a big question. I think where we're kind of offsides on markets is a lot of people in the markets have assumed that we're going to have a soft landing, when in reality, it's going to look a lot bumpier than we expect. Even if we do have a soft landing, I think we're going to have another growth scare at minimum. Now, think about the last jobs report that we had. We only added 12,000 jobs. significantly lower than expected. But Wall Street really chalked it up to hurricanes and Boeing, strikes. And we kind of overlooked that. The markets were actually really green when we got the last jobs report. Well, what if the jobs report on December 6th is really bad? What if last month gets revised negative? Then I think Wall Street is going to have to, at least in the near term, correct the expectations of a soft landing and put it more at a toss-up like probability. And if that were to happen, that would be how you get some kind of big correction in markets. Now, whether that happens on December 6th or whether that happens in the first few months of 2025, I don't know. But that is the risk right now in our markets, that we're all expecting this really strong economy, and it may not be as strong as a lot of Wall Street is expecting. Now, tomorrow, we're going to have a half day for markets. We really don't have any economic data coming out that'll be important. You have some data out of Canada, some data out of the Eurozone and the UK and France, but none of it is going to really move our markets. For next week, though, we have ISM manufacturing PMIs. Manufacturing's been in a bad place, so I don't know how big of a catalyst that will actually be. Construction spending, employment, new orders, and prices paid as well. On Tuesday, we have JOLTS job openings. Now, this number really fell in the last month to one of the lowest points we have been at since COVID, really, and we've seen a surge in job openings. You're expecting that's going to fall to 7.38 million. A big fall is going to be bad. It's really going to force Wall Street to question, how strong is the labor market? How strong is the economy? Now, on Wednesday, you have ISM services PMI. Now, services is about 80% of this economy, so that's the big one to be watching for heading into Wednesday. If services under impresses or disappoints, that's a big problem. You also have the Fed Beige Book that comes out at 2 p.m. on Wednesday, something I really like to read, that the Fed recommends investors read, because the Fed says the Beige Book is probably more accurate than the economic data that we're currently getting, and the last couple of Beige Books have not been good. Now, on Thursday, initial jobless claims will be coming out. Yesterday, they were good. They came in lower than expected, so we'll see if that trend does continue. Now, on Friday is your big data. Non-farm payrolls, again, last month we had 12,000. Look at the forecast here. 194,000 jobs for the forecast. That's a high expectation. Now, if we're able to meet that, great. If we miss that number, that's a problem. And I think for the first time in a long time, expectations are probably far too high. So that's an issue. Now, some of this has to do with the Boeing workers that will come back onto payrolls, right? So Wall Street's going to think about that. But you could have too high of expectations heading into next Friday. The unemployment rate is expected to stay steady at 4.1%. And again, you want to see a strong labor market. If you get a weak labor market report, then that does raise the odds of a cut in December. It would pretty much confirm a cut in December, and it would likely price in more cuts for 2025. But pricing in more cuts means a weaker economy, and that means a weaker stock market. Now, for Friday as well, you're going to get Michigan consumer sentiment, expecting those numbers generally to fall. We want to watch inflation expectations, current conditions, and consumer expectations. You want to see consumer and current conditions improve, and that would likely positively impact market sentiment in regards to the consumer, which, I mean, some reports are good, some reports are bad, and I just think that's where there's a bit of a toss-up here in is Wall Street's expectations offsides. Currently, the CNN Fear and Greed Index is sitting at 65. Yesterday, it was at 64. So definitely was a decent day yesterday. Market momentum, extreme greed, stock price strength is neutral, stock price breadth is fear, put and call options, extreme greed, market volatility is neutral, safe haven demand in extreme greed, and junk bond demand in extreme greed. Now, if we take a look at the percent of stocks trading above their 50-day moving average, there's definitely room for this market to get to move higher, right? For small caps and cyclicals, the internals of our markets to move higher before you're too far kind of bullish, right? You have 65.02% of stocks currently trading above their 50-day moving average. Heading into 2024, we hit as high as 85% of stocks, 86% of stocks above that 50-day moving average. You could still go up like 20% from here. So for anyone that's really, counting out a year-end rally or a positive December, should be mindful of this. We're really not that overextended, okay? Especially if you look, again, at the internals of our markets to judge valuation instead of the headline S&P. The headline S&P is expensive because big tech is expensive. If you look at the average stock in the markets, they're trading at pretty average, normal historical valuations. And I think that's where you could see a boost to those valuations if the soft landing kind of narrative is supported really over the next week here. Heading into next week with the jobs number, as long as that's good, you're going to have a good December. So I think December 6th is the big date to watch. If that's good, strong year-end rally. If that's bad, you could have a crash and or correction into the end of this year. Now, I do expect at some point in Q1, as I said before, you will get a growth scare, you will get a correction, okay? You will get markets that kind of freak out about a wave of bad data. And I think this economy, as far as the economic data, is really going to go in waves. You're going to have periods of really good data, periods of not so good data. And the markets could react negatively to that not so good data. And that's what I'm expecting at some point in Q1 after this holiday season. I would say the odds of a correction or crash from now into year end, probably like 30%, which is not a number you should ignore, but it's not a super high number where you should sell everything, go all in on hedges. If December 6th is specifically good, then I would put the odds of a year-end rally upwards of 80%. Now, you could see a bit of selling to start the year. That's kind of what you've seen in 2022. It's where all of the realization comes in. Once you start a new year, it's no longer about, hey, what's going to happen with this? What's going to happen with that? It's like, oh crap, maybe we do get concerned about tariffs. Maybe we do get concerned about a somewhat slowing economy, right? So I think that's really the danger is in January. It's in February, potentially in March. But I'm not super confident that we're going to have a huge issue in December, especially if we do continue to see 10-year treasury yields fall as we have seen over the last couple of trading days. This should start to support markets even more, with 10-year treasury yields at 4.26%, down from about 4.45% that you just hit on, November 13th or so and on November 21st. Bottom line here, momentum is to the upside. There will be positive surprises next year, as I believe inflation will come down more than expected. Shelter inflation is rolling over as far as current rents, and that should start to roll over in the, homeowner equivalent rents, which is just a crazy way to actually calculate shelter inflation. Like it's ridiculous to begin with. But I do think these things will roll over. Inflation will come down. We will get more cuts from the Fed. Again, the wild card is what happens with the economy, what happens with the labor market. And I do think we will get a positive surprise on less aggressive tariffs. That maybe that 10% China tariff, 25% Mexico, 25% Canadian tariff is all we get. If that's all we get, then Wall Street's going to love that. And I think you do want to prepare for the scenario that December 6th could be bad and you could have a correction in December. Although if December 6th is good, then you want to throw that out the window. December is going to be a very strong month, in my personal opinion, as long as that jobs report on December 6th is good. But you do want to be prepared for a correction, a pretty aggressive correction in Q1 of 2025. So let me know what you think about all of this information down below in the comments section. It was also not a great sign that we have not been able to close above 600 yesterday. You really did get rejected at 600. The only close above 600 on the SPY that we have seen is on November 26th. So you really do want to see a rally. If tomorrow we get a rally and we close above 600, that's going to be a good sign heading into the next week, which is, again, a huge week that'll really determine December. So let me know what you guys think about all of this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.